Hi, everybody. Welcome back to Ox Talks. It is Friday, December 15th, 2023. I was just talking to someone a little while ago, and they reminded me that a week from this Sunday is Christmas Eve. A week from Monday is Christmas Day. I don't know how you feel, but the holidays have come and gone so quickly this year. I hope all of you are taking some time and having some time to spend with family and friends. Need to obviously get back to the basics, understand, the true meaning of life and what the importance of life is, and that's family and good friends surrounding you. We all need that, especially during difficult times. For those that are struggling financially, I think it's even more important. I appreciate all of you tuning in to the show, watching the channel. I'm seeing the subscribers continue to click up, which means a lot to me. I do track it. I do read your comments. I try to respond. Please subscribe. Please like the videos. And most importantly, share all of this stuff with your family, your friends, your coworkers, colleagues, anybody who will listen at this point, because in the last couple of days, guys, the narrative has been shifting from, in the marketplace and all of the talking heads from fears of downturn, fears of recession, to now everything is fixed. Everything is fine. We're going back to normal. There's going to be no hard landing. There's not even going to be a soft landing. There's going to be no recession. We're going to avert an entire crisis, although nothing has really changed. I'll get to a story that touches on that today, and I think I saw at least one Fed speaker that was out today, who was pushing back against that narrative. The stock markets may be, getting the message a little bit today. They weren't as strong. There was a mixed results on Wall Street. I saw a text from a friend of mine earlier confirming how much money he had lost in the market today. So, from my personal perspective, we need to be careful rushing in on the hopium, because the statistics and the data is really bad as it relates to the consumer, as it relates to real estate, as it relates to the auto industry. We know the debt levels are out of control. So yesterday I didn't have a chance to get a video up. I think I mentioned on Wednesday's show that I had just a really long day yesterday. Started out with a court hearing, took about an hour and a half to get that completed and argued. And then I went right into a deposition that I was hoping it would last about 3 hours. Ended up lasting, it took me about 6.5 hours to complete that examination. Finished last night about 6, and by that time I was just kind of beat to start looking at news stories from the day and getting prepared to do a video. So appreciate all of your patience and sticking with me and the channel. Do my best to get something up every day if possible. Okay, are you guys seeing, I've been noticing this the last couple of weeks on the radio, I'm hearing advertisements from car dealerships about trying to entice people to buy vehicles. Leave a comment down below and let me know if in your neck of the woods you are hearing these radio advertisements, but they sure are trying to suck people in to buying a car. I've been hearing one repeated on the radio the last couple of weeks out here in Southern California that talks about, if you have a dime and a job, if you have a dime, 10 cents, and a job, you can drive a car off their lot. And their whole slogan is dime and a job, and they make fun of it, and it's a singing thing, but that is the slogan. And of course they say that, and then they lower the tone of the advertisement at the end, and they have someone speaking extremely fast, laying out all the fine print terms and conditions. But the mere fact that would even be something that could be put out there, if you have a job and you have a dime in your pocket, just show up and you can drive a car off our lot. That is how hard up these people are to move inventory that they cannot move. Now, do they look at the credit score? Do they look at what kind of job you have? Who knows? I wouldn't be surprised if the underwriting is very, very loose. Another one I saw, I heard on the radio, actually just a couple days ago for the first time, is a sign and rent. Same kind of a thing. They say, come in, you sign, you rent the car. And in this proposal, there are no payments. They said you don't make a first payment, you don't make a down payment, you don't make a security deposit, you don't have any out-of-pocket obligation whatsoever. You just drive the car off the lot. Again, at the end, they go to the fine print and they speak real fast and lay all that out. But This seems to me that it smacks of desperation. And I think what we're going to continue to see is a buildup of inventory on these car lots. And we're also going to have a buildup of consumers that are unable to buy this stuff, unable to even finance this stuff because they have terrible credit scores, they have no job, or they have a low-paying job, and you have these car dealers trying to force feed these things on people that should not be buying them in the first place. And that applies to any kind of an asset that you can't afford, or that you have to go in there and finance on a high interest rate for 72 months or whatever it is. All right, first story I saw, it was yesterday's article. I was going to share it yesterday, of course didn't have time, and it follows on the heels of what happened in the markets Wednesday with the Fed. And this is out of Market Watch. It says the Fed is quietly signaling that stocks are overvalued and a recession is almost certain. And this is from top economist David Rosenberg. And in all fairness, Rosenberg, has always, called for, he's a bear, and so he's called for, downturn for a while. But we should listen to what this guy's saying because he lays out here some data behind it. It says investors sent the Dow to a record high on Wednesday after the Federal Reserve signaled the inflation threat is fading, and it expects to cut interest rates 3 times in 2024. It says they may be celebrating too soon, David Rosenberg has warned. He says he's a veteran economist, the president of Rosenberg Research, noted in a pair of posts on X on Wednesday that the Fed's latest growth projection suggests stocks are overpriced and a recession is virtually guaranteed. And then he made a couple of posts on X. One of them says the Fed is calling for a tepid 3.8% nominal GDP growth next year, but the stock market is pricing in a plus 10% EPS growth, earnings per share. And he says both cannot be right. And his next post on X said, Powell didn't want to talk about a hard landing on the podium, but the Fed's 3.8% nominal GDP growth projection for 2024 gave us the answer in any event. This has a 90% recession probability attached to it. And then he says, shh, with the quiet sign. So he says, he questioned why the stock market is pricing in a 10% rise in corporate earnings next year when the Fed only expects nominal economic growth of 3.8%. I think it's a really good point. Says he says, quote, there's no recession risk at all embedded in equity valuations, Rosenberg said in a research note on Thursday, emphasizing that he believes the stock investors are too optimistic about what's ahead. Well, look what happened at the markets on Wednesday. I think the Dow was up over 500 points. Jim Cramer's out now saying that we're at the beginning of a new bull run and buy stocks. Rosenberg also cautioned on X that the Fed's forecast of slower GDP growth next year implies a 90% probability of recession. He explained that his team expects inflation to plummet below 1% next year, making 3.8% nominal growth very difficult to achieve and closer to 2% more realistic. And he says that is rare but not unprecedented. We saw this in 1949, 1954, 1958, 2008, and 2009. And here he says all recessions, he said, maybe the odds are 100% instead of 90%. And he finishes what I think is a great statement. He says, "That was delayed. What was delayed in 2023 shall not be derailed in 2024." So I think that's the quote of the month. What was delayed in 2023 shall not be derailed in 2024, which means they can only kick the can down the road so far, which means that from my perspective, you should be extremely cautious with the stock markets. I've been receiving several comments from people about, that people should be in the stock market, that people are leaving money on the table by being on the sideline. I'm not going to weigh in on that. My only comment is you just don't know when they're going to pull the rug out. And if you subscribe to the belief that this is still a wealth transfer mechanism to suck everybody in, mom and pop people that can't afford to lose, $50 or $100,000, and then pull the rug out when this thing tanks. Everybody else has already ridden it up and sold out early. So again, I mean, you have to take your own, you have to follow your own path. But this guy's perspective, I think, is valuable and something to pay attention to. It doesn't appear to me. Oh, and by the way, the Fed chair, I think it's the New York Fed, Williams was out this morning, I saw, and he was saying that there were no discussions at all taking place at the Fed committee about lowering interest rates. So how does that jive with Powell's comments on Wednesday of 3 cuts projected in 2024 and 4 cuts projected in 2025, when you have one of his colleagues on the board coming out and saying that's not being discussed? So we're getting a lot of mixed signals. It's hard to shift through all of the BS, but all we can do is protect what we have. Do the best you can to be cautious. Proceed with all due caution on any financial decisions you're going to make. If you don't have to make financial decisions right now and see how this plays out into the next quarter in 2024, I think it wouldn't be a bad approach to take. Next article it was today from MarketWatch. It talks about commercial real estate. Again, this is continuing as well. Nothing has changed. Commercial real estate, a top threat to financial system in 2024, regulators say. It says inflation, rising interest rates, and the persistence of work-from-home arrangements have battered the sector, and U.S. financial regulators are keeping a close eye on the industry, given that commercial real estate loans are widely held by banks, insurance companies, and other financial institutions. The Financial Stability Oversight Council issued its 2023 annual report on Thursday and listed commercial real estate as the first in its list of financial risks to the U.S. economy. And it says commercial real estate loans totaled nearly $6 trillion in the second quarter of 2023, roughly half of which were owned by U.S. banks, and that's a substantial volume of these loans set to mature, a substantial volume of these loans, listen, are set to mature in the next few years. And that's the key, because when these loans mature, if the rates haven't come down substantially, the borrowers will not be able to refinance these loans, and they will, instead of refinancing them, they're going to give these properties back to the banks. And the banks are going to get overloaded with commercial inventory that'll just sit there. It says regulators are concerned that a vicious cycle may take hold whereby elevated office vacancy rates leave borrowers unable to finance their debt, which in turn leads to distressed sales that impact the value of neighboring properties. Yeah, one distressed sale impacts the surrounding properties, impacts the block, other properties around it of like kind. So, there is a contagion effect when this stuff starts ticking off. It says, given that commercial real estate loans are the largest loan category for nearly half of U.S. banks, and that 1/4 have commercial real estate loan portfolios that are large relative to their capital reserves, bank watchdogs also fear that trouble in the sector could lead banks to lend less to all sectors of the economy. And it could very easily cause more banks to start collapsing, more regional and small banks into next year. Vacancy rates are now also rising in large multifamily apartment buildings, and property values in that sector have fallen 4% from pre-pandemic levels and 16% from the year prior, the report says. The study showed that smaller banks tend to have greater exposure to commercial real estate debt, which could signal that the struggles in the regional bank sector will continue. No surprise, it's absolutely going to, from my perspective. So this is talking about the commercial real estate, guys. It is on the horizon. It's not going away. These loans were taken out at very, 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 very low rates. That even if the Fed did decide to reverse course over the next year, 2 years, these loans are going to start coming due. And these people are going to have to pay the piper, and you're going to see a lot of distressed sales, a lot of commercial foreclosures, I believe, and a weakening sector, which is going to bleed through into the banks. And look, it all flows downhill ultimately to the economy and to the consumer. So again, let's take the blinders off. Let's keep our heads on a swivel. Let's watch this unfold. I know things slow down now into the holidays, and all of you are thinking about family, friends, and getting ready for Christmas and all that. Same with me and my family. But I'm going to continue to come out here and put the stories out. With that being said, I'm going to go get my workout here in about an hour. And I hope all of you do the same today. Please take care of your health. Please get your steps in. Please do some strength training and drink your water. We need to be healthy as a community and as a populace going into next year, and just generally for our mental health as well, and to help us control and reduce our stress levels. So again, appreciate each and every one of you for watching the channel. I will see all of you most likely tomorrow. Thanks. Have a great night. Bye.